right, Joel. Well, hey, thanks for joining us. I'm super excited
Thank you all for
to
having
have you
me.
join us. Absolutely. Well, to be honest, this is going to be a learning experience for myself. I typically deal with the investor side, and you deal with a lot of the financing, the money, what makes sense. And so,
No, we do.
yeah, a little background on yourself. You joined Meridian in 2015. You currently serve as
Yep.
vice president of the company's operation based out of New York City. You're responsible for managing a team that originates hundreds and hundreds of loans. I don't know if that's per month or per week, but you're you're a numbers guy.
Sounds like a lot. Sounds like a lot. So actually, I'll tell you, and I think you've got my bio from Meridian's website, which I got to tell them to update. But I actually, so we work on a team originally from our New York office. We moved out to Cleveland, Ohio, a couple of years ago. So we have a team out here. Yeah, I know, right? And you're like, what are you guys doing there? But
Did you like
so we have a team,
LeBron that
myself,
much or
Jonathan
what?
Silver, who I post LeBron, man. So I don't know. I got here and everyone's like the Browns, and I'm trying to figure out what everyone sees in them, but I'm still waiting.
Well, at least the
What can I
weather's the
tell you?
same.
At least the weather's the same. Yeah, we got that. We definitely got that. And Guardians almost put toe to toe with the Yankees. So yeah,
Yeah. So have
we'll
your roles
bring it
changed
home.
then? Because I noticed on your LinkedIn, I was sleuthing and it said managing director. And then on the website,
Yeah,
it says something a little bit different. Or do you still oversee the construction and the placement of permanent financing or?
we do. So basically, what we have here, we have so Meridian as a firm been around for 35 plus years. As a company, does 55 to 60 billion dollars in debt brokerage annually. Um, and was started in New York. Folks who started are still there, but it's obviously grown and expanded around the country. So we've got offices all over, West Coast, Middle of America, etc. Our team, we've got a team of about 10 folks here in Ohio, which is just happens to be where we are. But we're really focused as a group primarily in the Southeast markets. So, extremely active in Florida and Georgia and in Texas and Carolinas and so on and so forth. And that's a market which our group is kind of focused on even before it, I think, kind of hit that peak attention that it did post COVID. So I think what we've kind of brought to the table and have been the beneficiary of is just a real familiarity with those markets, understanding the dynamics, understanding how lenders view those markets, just knowing people on the ground, right? Like appraisers and things like that, where you really have real kind of boots on the ground market intel. I mean, we're traveling to those locations, every other week or so. Plus, it's an excuse in the winter to get out of the cold here, so and the snow. So, but yeah, that's what we do. Yeah, I'm myself, Jonathan. We help kind of lead the group. We have a couple folks who originate for us, and then some folks who are more involved on the placement and execution side, and we're just making sure that deals are getting done. That's really it. So
Very, very cool. So you've been with them for about 7 years now. Were you also in
yes,
finance or that same industry before you joined them?
real estate adjacent,
Okay.
but realized that this is brokerage is where I wanted to be, and had the opportunity to join Meridian, and haven't looked back. So
Okay. Well, this call is all about adding value to the listeners. So I'm encouraging anybody on the line right now to put your questions in. I'm seeing some people that they're investors of ours that always ask debt related questions because they understand that the
sure,
bank, well, the bank's the biggest investor in the deal. People don't typically think of it that way, but
very
they
true.
really are. And I think the power of leverage is how we're able to create so much value for the investors because when you're borrowing 70% or 60% at 3 to 5% cost, and you're trying to create a return profile for these investors that have a much more expensive cost of equity, that's where you can really create the value. So the bank partners are super important, and I don't necessarily get to see
Absolutely,
that
it's
side.
what drives the market. Yeah,
It's the difference between, well, it's one of the key differences, in my opinion, why the leverage in real estate is is a lot more attractive as an investor compared to stocks. But there's a
100%,
out of other
100%.
but
Yeah, and then there's the fact that you don't have liquidity issues the same way where you can get margin call. I mean, it's illiquid, but in a good way, in the sense that you can get debt, and it gives you the opportunity month by month to work your business plan and execute on your on your plan and your pro forma, and kind of play things out over a longer term horizon, if you will.
All right. Well, let's hop into it. You're in a super dynamic time right now. And so what's your day to
Yeah.
day look like? Because you're waking up today and the numbers are looking different than yesterday. How do you typically start your day off so you get a sense of where the market's at?
Sure. So, I mean, the very first thing you're looking at every morning these days, and I mean, frankly, you're doing it multiple times a day now, is just double checking where all the indexes are. So, and key indexes we're looking at typically are 10-year Treasury, 5-year Treasury, and then really SOFR is the other big one. And there's two SOFR. There's SOFR average and term SOFR. So you're looking at Treasuries really drive long-term fixed rate debt. Every lender either is going to price over it, or it's going to materially impact where their fixed rate pricing is, even if they don't quote you a deal over that index. And then SOFR is more relevant for your kind of shorter term floating rates, potentially bridge debt, etc. And that's something that you obviously want to be paying very, very close attention to. So those are the two things that we're looking at, and and just monitoring and seeing how it's really ties back. Once you do that, you're then looking and saying, okay, what are the deals on my plate today? What do I have? And how do those numbers affect everything we're looking at? Because these numbers right now, I mean, it's probably not going to come as to surprise anyone on the call. Markets are moving very fast right now. There's no question about that, and you really have to be on top of, okay, you're getting X amount of debt potentially. If you have a client looking at a deal, and you're sizing it to a certain debt levels, and as treasuries move, that's going to affect what the lenders are willing and able to lend you on that deal, and affects returns for the clients. It affects leverage points. It affects everything. So we're really trying to monitor that, day in, day out, and just try to stay ahead of it as much as possible.
Yeah, and this might be a side question, but I'm here, the difference between now and 2008 is banks have trillions and trillions of dollars versus in 2008, it might be a little different situation. Um, you guys are still incentivized to put money on the street. Are your margins getting smaller because of the cost of money's gone up, making the returns from an investor perspective smaller? How are you guys adjusting?
Sure. Yeah, so that's a good question. So actually, let me clarify one thing if I wasn't clear at the beginning. But our firm, we are purely third-party brokerage. So in the sense that we don't lend any capital, we're acting as a representative on behalf of the client, Viking, or any of our other clients, to go out and place loans with, a variety of lenders out there. It could be local banks, it could be national banks, it could be life companies, it could be private capital, etc. So why I happen to love that, just by the way, is because what I do find, especially in markets like this, is you're going to have lenders going in and out of the market, trying to adjust their strategies, trying to adjust their pricing. You have lenders who have a particular source of capital where that capital has a certain cost attached to it that just doesn't make sense in today's environment. But then you might have another lender who has an initiative to go out and lend because they need to put loans on their books. I mean, lenders, here's a good thing. Lenders, people sometimes don't think about it. Lenders love to lend. That's their business. That's how they make money. They don't make money sitting on the sidelines and doing nothing. That's how they all end up out of jobs, and their loans just end up by the servicing department. So lenders love to lend. Obviously, they have to lend in a sense that is profitable for them and is makes sense, and they're not going to do things that don't add up. But lenders love to lend.
And they have
think
to feed their family.
What we're really seeing right now, yeah, exactly. I mean, this is a business there, and they love lending. Now, our lenders kind of looking at the environment we're in and saying, look, we have to adjust, and we have to, spreads may change, yields may change. There may be adjustments in terms of where they're willing to go in terms of, leverage. and sometimes it's even like you get to the end of the year and a lender might say, look, we filled up our book for, for we hit our goals for the year. Let's, we have one lender we're working with right now. They'll give extremely competitive terms if you can close in 2023, right? Like, because they hit their goals for 2022. 2023, we want to start to put loans on the books now. So
Interesting. I sounds like you're kind of a free agent, and the fact is that's allowing you to better serve your clients because you have multiple partners that you're working with, rather than just being constricted and constrained to what your particular bank is able to offer. So that's pretty good.
that's exactly right. Yeah.
So we got a question that came in from Amir, and his question: are you okay if I just field questions that come in from the audience and we
let's do it.
Okay, so Amir asked, what are the current trends? Obviously, we know high level trends, but what are the current trends that you might be seeing? And when do you think the debt markets will be stabilized?
It's a good question. So, look, I think to kind of go, I'll tie this into what you were asking before, right? Comparing it to, say, the '08, right? And look, I was around in '08. I wasn't doing this in '08. So, but we all kind of know what happened then. And I think the biggest fundamental difference is back then you had a liquidity crisis, right? You had a situation where capital and the capital markets just shut down. What we have today is, if you want to call a crisis at that, it's an interest rate problem, right? It's the government wants rates to go up. I mean, we can get into it or not. I think we've all hashed it to death, maybe a little bit over the last 6 to 9 months, but Fed got rates to go up, so they're raising their indexes, and it trickles through and affects where all the other, where treasuries and so forth and all that goes. Lenders still want to lend, right? And it goes back to what I said before. Lenders are in business to lend. They want to lend. They still have the capital to lend, and that's a huge difference, right? Mm-hmm. I have lenders who are, and look, lenders are having, in some cases, a tougher time lending because there is less transactional volume going on, right? There are less sales happening today as the market figures out, okay, what's the appropriate price for a deal? How do I match it up with the right debt? There's potentially less refinances going on, as we're not in an environment where people are chasing, when everyone's got 4% loans and rates go to 3%. I mean, brokers love that moment because you call everyone up and you say, okay, let's roll your 4% loans and 3% loans. It doesn't usually work the other way around. I don't call people and say, let's go from 4 to 5, right? So, or 4 to 6. So it's things have definitely slowed down in that respect, but lenders still want to lend, right? And so I think as far as what the trends are and where we kind of see this playing out, look, rates are up. There's no two ways about it. I think it's pretty accepted that it's probably going to be, another probably 2 rate hikes coming from the Fed before the end of the year, and maybe a bit more into next year. Beyond that, really anyone's guess. But I think at some point we do start to see the effects of that in the market, and then the Fed starts to slow down. And I think when that happens, you'll see a stabilization, maybe even a pullback, where the market starts to say, okay, look, we can kind of see the other side of this, and things kind of find an equilibrium. I mean, I think, one thing I find in this business in general is that sometimes just having stability is the best thing, right? And it's when things are very volatile, it makes it very tricky because it's tough, as owners, right? It's very tough. You're going out and you're sourcing deal flow and trying to find new acquisitions. Where do you price your debt, right? And so you can call me and ask me, and Vic and Ravi, we get on the phone and we talk, literally every week, and some of the other folks at your group, and we're having conversations. But what's relevant today is not relevant tomorrow. It's being adjusted and updated in real time. And so I think maybe we get into Q1 next year, Q2, and things feel like we're turning the corner, and that just settles things down a little more. So it gives you just a little more runway to say, and again, where does a long-term debt shake out is anyone's, that's anyone's guess, right? I mean, it's hard to kind of pin a number on that, but just having a sense of like, okay, we're here, this is where it's going to be for at least the next couple of months, gives you that window to go out and get deals done and know what you're getting yourself into, and not kind of get, blindsided every single week as things move.
Yeah, it's funny you mentioned that. It reminds me of a Peter Lineman podcast I recently heard. You know Peter Lineman, the astute
Sure.
economist, and so he was talking about how we basically went for 2 years where things were free that actually had a value, and now with the rising interest rates, the money's going to move back to the things that actually have real value. And so he actually
Yep.
believes it's going to be better for the economy because there'll be a correction in the sense that we'll only be focusing on tangible assets with value, which is the space that we play in.
It's
So
real estate for you, man. I mean, look at like venture capital and all that. I don't know how closely everyone looks at that and follows that. And obviously, that world's made a lot of money over the last little while. Um, but today, it's all about, is that company profitable? I mean, that's it,
yeah,
right? Is that company making money? And if it's making money, it can still get financed. It might IPO or whatever. But the world today wants real hard assets that show real profits, real growth, real stability, aren't going to just, poof, disappear with, at the touch of a button. And I think long term, with all the shakeup that we have going on right now, that's where you're going to see long term growth, long term stability. It's why real estate just, despite all, the shakeup that we have going on right now, and people are nervous, I think long term, it's the reason why it's a good place to be.
yeah. Also, it sounds like you're stressing that, and somebody on this call actually demanded, and we shared it with them, to see the financial sensitivity analysis, the cash flow at different costs of money. And from an investor perspective, I encourage our investors to ask from that, whether it be from us or other sponsors. There's another question that snuck its way in here from Cy, and it says, given it's the end of the year, a lot of capital has been deployed. What's your perspective, Joel, on the best debt options in the market right now? Do you feel that because you think there's going to be 2 more increases in the interest rates, you should stay away from bridge, or maybe do bridge if the deal has enough meat or enough fat on it to where it makes sense even when the rates go up?
Yeah, it's a good question. So it's here's how I kind of look at it today, and this is how we're kind of advising clients, which is you have to balance out on any deal. You really have to balance out how you view the long-term or short-term and long-term prospects of the deal from a business plan standpoint, back to kind of where you can go get debt, right? So, a big thing that happened obviously in the last, since early this year when things start to run up, everyone says, okay, I want fixed rate debt. Okay, right? We get it. You don't
And
want
it
to
did
deal
make
with
sense.
floating risk, right? Exactly. And then interest rate caps are obviously very expensive. Having said that, let's say you come across a deal that's got deep value add, right? Like it's just, the seller's not, great owner. They've stewarded the property well. They're just best friends with all their tenants. They haven't raised rents in 10 years. Would it make sense? Now here's the thing, right? You're going to buy that deal today. It's because the rents are very low, and, coupled with the fact that, even fixed rates are high, right? So you're going to go borrow in the markets. You're going to get very, very conservative debt out of the gate. In addition to that, when you go get longer term fixed rate debt, in many cases, it's going to come with, whether it's lockouts or larger prepayment penalties or whatnot, because, hey, if a lender is going to lock you in long term, they want to know that they're going to make that coupon, that yield for that, for that period of time. But you're looking at this deal and you're going, look, we're getting in at just such an attractive basis. We know we can get rents up. We know that there should be a massive, let's put, take our most conservative approach about where we think rates are going to be in 2 years, 3 years. We believe we can execute on this deal and have a massive, capital event 2-3 years from now.
Even
It doesn't make sense to then go and lock yourself into 10-year debt, long-term fix that you're going to be stuck in, right?
Yeah.
That's the question.
With the
And some people might say, yeah. And some people might say, yeah, you know what? I don't care. I just, this is what this is what, but we have clients who are saying, no, you know what? You can still go get bridge debt. It's definitely out there. I'll be the first to say it's not. It's going to be a lot smarter and more intelligent and a little more conservative than it was, say, a year ago. Um, I would say spreads we've seen kind of hold steady right now in terms of where spreads are, but obviously the index is up, right? Right. So SOFR, which we price over, SOFR going back to the beginning of the year was 10 basis points. Today you're looking at between 3 to 3.5. That's an increase in 300 to 350 basis points in what that debt is going to cost you. And then you may have to go buy a cap, and the cap's going to cost another, potentially 2 to 3% of your loan cost is going to go back to the cap as well. So there's no question it's expensive. That said, we have a client. We actually just signed a bridge deal up today, and it's 70% of cost. And it's a deal that they feel very strongly that in 18 months they're going to be able to recap the deal, and they don't want to be locked into something long term. And so they're willing to kind of make that trade off. So it's really what I would say is it's really deal dependent, and some of it's your appetite for risk, right? But it's if you're going to buy a deal that you're going to lock yourself long term in where there's really just no return, then that doesn't make sense either. So
Yeah, I like that you said that, because I always try to stress that real estate's hyper local. What you look at the national averages, you can't invest in a neighborhood based on national averages with the assumption that the national average is going to happen in that neighborhood. You have to look at the neighborhood demographics and the trends in that neighborhood. And then you talked about the long-term decision-making analysis. I try to ask myself, do I think, based on these fundamental trends, do I think that the news and the newspaper around this deal is going to be good, 3, 4, 5 years from now, because that's when we're going to sell. That's kind of what I tell myself. So you know a lot more what's going on in the financing than myself, and in the markets. You follow that every day. Are there particular red flags or concerning things that, or something that you would say is a no-go today when you look at a capital stack compared to January? So you're looking at how the
I mean, just if you're talking about a couple changes, right? So I think, look, a lot of what drove the market over the last couple of years was very inexpensive bridge debt, no question about it, and aggressive bridge debt at high leverage. And we did see bridge lenders willing to lend to, frankly, almost anyone. It could be a guy who, some guy is out of college, he's doing his first deal, and he, went on LinkedIn and he found some investors and they syndicated it out, and but there's no real experience, there's no balance sheet behind them, and I think that's probably one of the biggest things that I'm seeing change. I mean, even to your point, like you said earlier about locality and real estate being hyper local. I mean, we're getting asked more. More than ever about sponsor experience, and not just sponsor experience in general, but sponsor experience in that market, in that asset class, in that business plan execution. And this is even on deals that are stable, right? Like it's, I think the capital markets in times like this, there's no question that, lenders are smart. Like I said before, they want to lend, but they also don't want to lose money, right? And the number one thing that they can do is look for sponsorship that has experience, has a track record, is well capitalized, has market expertise. Talk about deals we've done with Viking. I mean, it's going through all the deals. You take Atlanta, right? Like Atlanta's a market where we've gone through. We can sit there and go through 6 case studies. Well, and say, okay, we're showing you the lender this deal, but let me show you why they've done this again and again and again and again. And they've got boots on the ground there. They've got a management company that's local to the market, and manages not only all their properties but other folks' properties. So there's market intel there. I think we're going into an environment where having sponsors who are just better quality sponsors are going to have more opportunities, because some guy trying to do his first deal today is going to have a tougher time. No question about it, and is going to be way more limited in what their debt options are. And right, like debt drives the market, right? If you can't get great debt, then deals are not going to work. And that's why I think, I mean, there's going to be good opportunities, today and coming down the line for better quality sponsors who, have a real track record behind them.
Yeah, it's interesting you said so. So I've been raising money for syndications before the pandemic, and I remember the average investor I spoke to pre-pandemic was 58, and then the average investor age that I spoke to, let's say the middle of 2021, it dropped down to 43. And I
Wow.
think it was
Yeah.
because people realized that they couldn't necessarily count on their single income job and they needed other income. So syndication became really
100%.
sexy, real estate
Yeah.
became really sexy. And then you're talking about the lack of experience, the surge of new operators that they're just getting money thrown at them and they're going into pretty risky bridge situations. Um, do you think that there's a, I don't know the numbers, but how many do you think there'll be a noticeable amount of people that are utilizing floating rate financing that will have to sell in the next 3 to 5 years when those loans come due or like
Yeah.
they're over leveraged and because
Sure.
they thought 2020 is a forever thing, or
You'll see it. I think we're still in the early stages of it. Again, I don't see it as distress in terms of like assets falling apart or being sold for
Mhm.
pennies on the dollar. But yeah, there's no question that, I mean, you know, there's gonna be sponsors out there who really didn't know what they were doing and got into deals, and they're just either they're running out of time or they didn't. I mean, I'm already hearing stories of folks who just they don't know what they're doing. They don't
Yeah,
have the experience. They did their first deal. Turns out renovating things is harder than you expected,
yeah,
and they don't know how to manage. And eventually, those loans are going to come due or have to get rebalanced. And I think we will see either sales at a discount to kind of where they came in, or the opportunity for more experienced, well-capitalized sponsors to come into those deals, put some equity in, and
mhm,
come in at a lower basis and kind of take over those deals, which I think is going to actually make for some very attractive investment opportunities when that time comes. No question about it.
I wonder if there'll be a concentration of that happening in the markets that certain educator gurus were telling their students. Like I just came back from a Dallas event, won't say the name, but I was blown away at
Yeah.
there's 3,000 seats and the guy's rattling off Texas and Florida markets and I'm like, oh my gosh, maybe there's going to be some short-sighted deals from the last couple of years that are more likely going to happen in these markets that are already pretty hot. I
Yeah.
wonder if there's be a concentration in, let's just say, those two: Arizona, Texas, Florida, those three states.
I think there will be. Yeah, without
Yeah,
naming names, but yeah, I think. Look, sometimes it's as simple as, like, you have these groups who did a deal and just are undercapitalized, right? And they can't go back. Like, the sponsors don't have any money, frankly, right? And so, like, if there's an overrun on something, how do they cover it? The answer is they don't, right?
yeah,
And they're, so you kind of have paralysis by the fact of just too many cooks in the kitchen, no one with any real skin in the game. Um, it becomes a problem. But look, and problems becomes opportunities is kind of how I look at it. So
yeah. Do you think that more people are going to do fixed, even though it's fixed financing, even though it's more expensive, or do you feel like it hasn't quite penciled enough to where people are going to start going back to fixed more?
so we're doing some fixed. And what I would say is, and this is like, look, the market's moving, and lenders are kind of going in and out of the market. So there's always new products out there. We actually signed up a deal today, a recap for a deal in Tampa. A client bought a deal with a bridge loan about 18 months ago. Um, and he absolutely killed it. He crushed it. Like, he
Yeah,
just executed above and beyond all his projections. Um, and so here's the thing, right? So he's got another 18 months on the bridge loan before extensions. But obviously, like everyone else, he wants to, that deal's floating. He wants to get out of it. He wants to repatriate, some equity. And so, what are my options, right? So
yeah,
He wanted fixed. He wanted fixed because I don't want to float. I don't want to go buy a cap. But, and this is the thing, he's like, look, I still feel like this deal, like I've executed above and beyond like what my expectations are, but I still feel like I know this more. I'm a local guy. I have boots on the ground. I know the neighborhood well. I see what's going on. There's other like, I've got older vintage stuff. There's Class A stuff coming in that's going to like push rents up in the market even more. And he feels like I'm going to be the affordable product in the market. He's like, I got another 30-40% of my rents to go in the next 2-3 years. And he's like, I don't want to lock myself into something where I'm locked in for 10 years and then I wake up in a year or 2 years from now. I mean, forget what rates are, but like,
Yeah, yeah.
I'm going to be locked into something. I'm leaving money on the table. So, we were able to get, we have a lender who kind of came into the market with some capital. They're doing fixed rate 5-year loans. It's similar to the agencies, but we were able to negotiate a 5-1-1-1-1-1 prepay on this deal. Paid a little more for it. So in other words, it's a 5% prepay if you repay the loan in year one, and then thereafter it's 1%.
Okay.
Right. So it's a 1% exit fee. So 5-year deal, 5 years IO. The rate's high. No two ways. The rate's high with any loan today. But the idea is he's got a fixed rate deal. It's IO, interest only, so that he's not paying any amortization down. So he's got great cash flow. And if he decides to stick with the loan for 5 years, he'll stick with the loan for 5 years, no problem. But if rates, pull back in 12 months from now, and he's got his rents up again, we go back and we refinance him once again, and he's got a 1% prepayment, which is nothing in the grand scheme of things. So that's part of what we're doing right now, is trying to like get creative, and find new products and find new lenders that just make sense for a particular deal.
That's fantastic. You basically answered the next question, which is, are there other options besides, bridge and agency, and what are people doing to get creative? And you just gave an example. So that's
there's a lot. There's a lot. I mean, look, I don't want to pretend it's easy, but fortunately, if it was easy, I wouldn't have a job. So it's what we're finding is that, and this is why, this is why I think we're so good at what we do in terms of just being in touch with the markets, the volume that we're doing. We're finding every month right now, as crazy as the markets is, there's another lender that shows up with something unique or something different or something creative. And, it doesn't work for everyone, but there's always that right deal, that right client, that right particular thing that lines up at that moment. And we're able to jump in and take advantage of it. We did a deal, we closed a deal, a cash out refi in Miami for a client about a month and a half or so ago. And it was with a bank. Bank had expanded into, it was a kind of Northeast bank that had expanded into Florida. And the client was also, again, exiting a bridge loan. And, it worked for, I think it was 42 million with the agencies based on how they were sizing and projecting. Every lender's got their own way of how they underwrite and look at things. We were able to get, again, a 5-year fixed rate deal at $50 million with a flexible prepay, and get that deal done. Now, here's the crazy part about that. We closed the loan, and this was just last month. We closed the loan. Well, guess what? That lender's done lending for the year. They hit their numbers, they hit their caps, they're good. So like, if you were like waiting for that lender to go be your lender for your next deal, they're not. They're right. They did what they said they're going to do. They got the deal done, but now they're good. Well, guess what? Now there's another lender that came along. I mean, I think Skyridge is a deal we closed together. That was a bank that we got super creative with. And at the time they were doing some very unique stuff in terms of sizing and underwriting. And we were able to get a very creative loan there. You might not get that same loan today, but you know what? Now I have this, 5-1-1-1-1, lender giving me full term IO. So it's bridge market's there. The agencies are still super hot. In many cases, you're still going to take a deal to one of those two sources. But for the right deal and the right time, there may be another creative lender out there for sure.
It just goes back. You can't do like a blanket paint over, a gloss over the entire industry. because it's specific.
Absolutely.
And then the financing, it really has to mesh with the needs of that specific business strategy on that project.
100%. Yeah.
That's really. Do
And
you
that's
think
something
that?
yeah.
Oh, go ahead. Go ahead.
No, I was just gonna say that's something you mentioned a good point of like something we pay a lot of attention to personally.
Yeah.
Like my team is not just like trying to pitch a product or sell a bank called, oh, I want to put some loans in the book, so call the clients and say, oh, I have a lender at whatever. It's really about understanding, you know, y your deals, your business plan, your time frame, your equity, your structure, like all that, and then trying to kind of tailor up a loan structure that fits that is really, I think, the differentiator. So,
Are lenders, drinking some special tea now? How are they getting more creative, or do they always have those options, but they just didn't need to do it in the market before?
yeah, look, I think some of it is when the market's super hot, it really just becomes a pricing exercise, right? I
Right.
mean, it's a race to the bottom, and you're really just fighting for bips.
Okay.
Um, lenders will tell you, every lender will tell you they're better than the other lenders about this or that, which, by the way, sometimes is true.
Yeah.
But that's really what it is. In today's environment, lenders have to get, they have to get creative to put deals, to put capital out, right? Because, you know, it's look, the agencies are behemoth and they are lending. Um, there's a lot of, I think, skill and nuance that goes into that as well. But if you're competing against that in particular, you got to get smart and creative about how you're doing deals and picking your spots. So
Yeah. So it got kind of forced out of necessity, it seems like, because the
yeah,
market changed. They're less commoditized and more specific for a particular deal.
yeah,
Um,
absolutely.
so
And
I
we're going to
got
see
the
more
question.
of that. Yeah.
Well, kind of have to. But I got a question coming in. I'm so glad Dinesh asked. Whenever Dinesh calls about our opportunities, he always asks for sensitivity analysis. He always asks on the debt. So he probably showed up here specifically because he knew you were on the call. And
All
but
right.
his question is, what type of stress tests are lenders requiring for these deals in this market? And he said, besides exit cap rate, where they're not doing any rent growth or rent concessions. So, are there any things besides the sensitivity analysis at the different rates that you're doing to stress test the deals?
So I guess the answer is really it does depend on the deal and type of lender that you're going to. Obviously, a bridge lender is going to stress differently than, say an agency or a perm lender is going to stress to. Um, on the perm side, I would say we're seeing, your kind of classic is your note rate at a 125 is really what we're saying. And then, where you try to get creative with it is, can you get a lender to drop that 125 to a 120? Or can you get that, I should add as well that you typically has a 30-year AM. Something that we did with some of the agencies just up until recently was getting them to go to a 35-year AM. And this is all about just trying to push proceeds, right? Because we're in a
Mm-hmm.
proceed constrained environment right now.
Mm-hmm.
Look, the advantage of that is today is that a lot of these deals on the perm side are getting done are lower leverage, right? I mean, the days of getting 80% leverage from a senior lender on a perm loan is just not happening in today's rate environment, right?
Yeah.
So, part of it is just getting lenders to kind of acknowledge, hey, I'm making a loan at 60, 65 LTV. I need some concessions there on your
Mm-hmm.
end, to kind of help that, right? Like another one we've been getting is technically when you're at a 125 DSCR,
Mm-hmm.
you're not going to get you might not get full term IO. But we've been getting lenders to say, hey, you know what? Because I'm at that 60, 65
We'll do it.
LTV mark, I'm going to give you that full term IO,
Oh
right? Because I'm
wow.
not at 80. Yeah. So things like that, little things. I mean, look, the in-place rates today are high enough almost that like lenders, I don't want to say they're not stressing it past that, right? Past where the rates are today, but they're obviously, it's hard to predict where rates are going to be 10 years from now, right? So it's like, how do you kind of model that out? So I would say we're not seeing, the constraints are really not like, well, your rate's 5.5 or your rate's 6. we're going to stress your rate to 8.5 and lend you based off of that. It's
Yeah.
really not that. Yeah. Because I mean, then the
Interesting.
deal's just frankly, yeah, it wouldn't work at that
It, go,
level.
it goes back to being creative. So there isn't any new magic name stress tests that you're doing. You're just changing the numbers a little bit and seeing, okay, well, if they're a lower LTV, then intrinsically it's a little bit less risk on the deal. Um, and so,
Yeah, I would say, as crazy as this sounds, I would say if you compare where the stress tests were a year ago, let's say before the run up in the market, to where they are today, I would say the stress tests are actually more favorable to the borrower today than they ever were a year ago. Now, again, because of where things are in the market, you're still not getting as attractive as a loan,
uh-huh,
right? But like lenders are basically willing to kind of bite the bullet a little more today than they were a year ago,
yeah,
on a relative basis to make deals work, um, than they were. They might have given, let me give you an example, right? They might have given you a loan at 3% a year ago, right? And then stressed it to 5 or 5.5, or so 250 basis points over the where they were quoting you. Let's say they're giving you a loan at 6 today. They're not stressing that. We're not seeing them stress that all the way to 8.5,
mhm,
right? Because they're not going to win the business that way. So
yeah,
on a relative level, I think lenders in sense have actually gotten more aggressive, and intelligently so, to kind of adapt to the market and say, we're not going to just blow things out, on a long-term basis, in order to make deals work.
such a delicate balance between driving the business, but then also not losing your buns by giving away money when it's risky
Yeah,
money. Well, we have a couple more questions. Really appreciate your time.
yeah, sure.
If you're listening in, please ask last couple questions. I'm going to ask you to be a fortune teller. Are you okay with that?
I get that. I get asked it every day. So
Get out your magic orb, and we're just kind of curious. Where do you see interest rates going? You mentioned, do you think it's going to go up another two times? Um, let's let's say you're right. It goes up another two times. How do you think that will affect the transactions moving forward? Do you think it's going to be more of what you just talked about? Lenders being a little bit more aggressive, changing the way that they do their sensitivity analysis, or what do you
I
think?
do. Yeah, I mean, look, we may see rates, somewhat higher in 3, 4 months from now, than we do today. I don't think that's a crazy thing to think.
Yeah.
Which is why, look, if you're doing a deal today, there's no question. Either A, you want fixed rate debt, right, where you're locked in and you're managing a risk, or you're getting a floater, but you're buying a cap, as expensive as it is. So you know what your worst case scenario is, which, it's, can I live with that number, right? Because it's
Mhm.
going to hit it, right? Like it's going to hit it, whether it's in a month from now or 3 months or 6 months, it's going to hit it. Assume it's going to hit it.
Yeah.
But then, hey, do I think there's enough upside in this deal outside of the interest rate market as a whole for this to make sense? That's how you're going to get deals done. And there's no question that, like, look, on the pricing side of deals itself, buying a deal, it's going to have to adapt to fit that, right? I mean, as rates go up, you're going to see an adjustment in prices. I mean, the days of I think people selling assets at 2.5 caps and 3 caps probably are past us, right? Debt has to line up to a point where it makes sense, and we're seeing that. We're seeing that in the market. So, look, I think there's definitely still the opportunity to get deals done. I think that you'll always be trying to find that equilibrium. And then I think at some point next year we see a stabilization, right? And I think the stabilization will actually result in a pullback on rates, because a lot of it is just a lot of what's priced in is uncertainty and risk
Mhm.
and long term, where are things going. When people get to the point where they have an outlook, um, you're going to see lenders want to lend. They have all this capital. They're going to want to pile back into the market. And when they do that, it becomes, again, you go back to that kind of race where everyone's competing on price. So, and that's going to help a lot for
So
sure.
the 100% markets hate uncertainty. Do you think it's going to be
Yeah.
2019 interest rates, or do you think it's going to be maybe a little? I mean, there's Peter Lyman had described it a couple of weeks ago. He goes, the economy is kind of like going to Thanksgiving dinner at grandma's. There'll be a little bit of stress, uh, but it's not perfect. But overall, it's going to be pretty pleasant. Do you think that the interest rates are going to be a worse scenario than 2019 or pre-pandemic, or do you think it'll be about that?
I think we get to some kind of like pre-pandemic level where, look, it's hard to see, long-term fixed rate multifamily debt going to 2.75%, right? Which we hit 2 year, right? Like, yeah, yeah. Look, barring some other kind of reason why the Fed starts going the other way and lowering rates again, right? Which who knows, right? That's the big unknown, but certainly not impossible. I mean, that's the tool that they have, and when they need to use it, they'll use it. But to kind of predict when that's going to happen, I think is very tricky. I think there's a really healthy middle ground where, if you look over, let's call it post '08, right? Like the market's done extremely well with, rates that have been somewhere between, I don't know, 4 to 5.5% on long-term borrowing costs. You can do deals and you can make money, and be successful with numbers at those levels. Um, and I think somewhere in that target is probably where we end up. It's enough of a yield. Again, if you assume that inflation slows itself down, which is what the government's trying to get
Mhm.
accomplished here. I think it's a yield also where lenders feel like they can make enough of a yield and a return, for it to make sense for them to lend at that level. So that's kind of what I would expect to see. And again, if you're good sponsors, with good balance sheets and I mean, they'll figure out how to do deals at those numbers
Yeah. Well,
all
last
day. Yeah.
question. So let's say I'm a newbie investor. I'm trying to look at somebody's debt tab within their underwriting. What are some good resources, or um, what's some good advice on learning where to go on learning more about the capital markets? Where would
Ooh,
you
that's a good
recommend I
question.
go? Yeah, just is there a particular news source that you trust, that you like to go to, that kind of gives you advice on how to look at these certain numbers if it was you 15 years ago?
I don't want to steer anyone in the wrong direction here. It's honestly like it's weird because like we're in a funny time, right? Where there's more information than ever online, right? But at the same time, because there's so much, it's like, how do you sift through that and figure out what's real, what's valid, or what's just, you know, people trying to, be dramatic about things. Um, look, it's a good question. I'll be honest with you. I don't have like a go-to. Look, I live this stuff, man. You know what I
Yeah.
mean? Like that's it's thank God it's why our clients are so successful and so incredible at what they do, and are so smart and intelligent about the markets. And this is why we continue to be their advisor when it comes to debt. It's we're living this every day. I mean, in terms of just basic fundamentals, I think I don't know. You look around the internet. There's definitely some good, like, I don't know,
Yeah.
good online just articles and newsletters where you can learn the basics, right? Learn the
Yeah.
fundamentals. Learn how DSCR works. Learn how cap rates work. Learn about the relationship between cap rates and interest rates. Learn about leverage. Learn the basics, right? Don't get too caught up. I think in where the trends are going and what the
Mhm.
products are and that would be my advice. Learn the basics and the fundamentals, and then just ask questions. Right when you see a debt stack from someone, ask questions if you don't understand it, and you'll figure out pretty quick. I like to say what we do is not it's not rocket science. So you'll figure out pretty quick the metrics on a deal and how the deal works, and where the risks are, and look. And the other thing I would say is ask questions in the sense of if you're looking at an OM or something and something doesn't add up to you, ask what the story is. Because look, it's the kind of thing where like the cold hard facts don't lie, right? But it's also pretty easy to like, you'll see this with like really inexperienced sponsors, right? And it's like, man, you'll have they'll have some projections in their model that just don't make any sense, right? It's like just not grounded in any kind of reality. And,
Yeah.
so, and again, if you know the basics and you know the fundamentals, you know how to ask that, look at it, go look at a T12, or, NOI or, gross rents and say, okay, if you're telling me year one is 30% higher, where's the gap? Where's the delta? And hopefully there's a good explanation, right? And if there isn't, then that's a red flag, right? So,
Yeah. Great points. It kind of reminded me, I just shared in the chat some excerpts from two books I recommend. The first one was What Every Real Estate Investor Needs to Know About Cash Flow and 36 Other Financial Measures. I don't know if you've read that one. I think it's been around for about 10 years now, by a professor out of Harvard or Yale or one of those prestigious schools. And then the second one was Questions to Ask a Potential Sponsor. And so you
that's a
really
good,
hit.
yeah, I like that.
Yeah, it's because people are not, I deal with the investors and stuff, and people are sometimes asking questions that should be their final question. They're asking it first. They
Yeah.
confuse returns with some sort of, you can't compare two projects based on their returns because you're completely dismissing the amount of risk on that project, well, relative to
Yeah.
the debt, relative to the business strategy. And so,
Yeah. I mean,
um,
look at IRRs, which you can effectively make whatever you want them to be based on whatever whole time or capital event you model out into the scenario. So it's I think first you got to understand sponsorship, right? That's first and foremost. Then you got to understand the deal fundamentally in and of itself, and then you can start to worry about, okay, what's my return or what's my IRR, or what's our whole time, or something along those lines.
yeah. Well, really thank you for your time. And I don't know if you're available for people to reach out to. I think that some of the people that will watch this, if not today, but in the future, do have opportunities. For they're looking for debt and stuff. I don't know if you'd be open for us to share either someone from your team's contact information or your contact information at Meridian.
Yeah,
But
sure.
if so, let us know and we'll connect it to the recording of this when we send this out. So,
Absolutely. Yeah, for sure.
okay. Well,
All right.
I don't
Well,
know.
Colin, appreciate it.
Really insightful. You brought up
No,
some
thank you.
creative stuff I didn't think about, because I'm not looking at those numbers every day. So um, I'm glad I had this conversation. Thank you.
Amazing. Thank you guys for having me on. I really appreciate it. It was fun.
Bye.
All right. Take care.